Hi everyone. Today we'll talk about Chapter 8, Part 2, Capital Budgeting. Let's start. In capital budgeting, in this part, we want to get we will have certain givens by the question itself. The given will be the quantity, the price per unit, the variable cost per unit, the fixed cost, the fixed assets investments. The depreciation usually will be usually a straight line depreciation will be used. Working capital, tax rate, required rate of return, and then we have to use these to get the cash flow. The first step, we need to make the projected statement of comprehensive income, which is income statement. Important calculations, depreciation, which we get by fixed investments divided by number of years of depreciation, because it's straight line. And as it's shown here, we get everything, and we as a normal income statement, and we get our net income. Next step, we make a capital requirements table. Here, net working capital is the same for each year. Here, the net fixed assets is not depreciated for year zero, because it's year zero still it's not used. Then it's depreciated for every year until it's zero at the last year. Step 3, we make the projected cash flow. First thing, we get the operating cash flow, which is equals the earnings before interest and tax plus depreciation minus tax. It's zero as the first year, as that no sorry, here it's no revenue made by the project still, and then it's the same for the rest of the project. Additional net working capital, it's negative for the year zero, as that it's paid in the project, but because year zero, it's the working capital is negative, because it's paid in the project. Then it's positive, as shown here, at the last year, because we collect it again from the project. At the middle, it's zero. The capital investments, which is the fixed assets investment, it's negative at year zero, as it was issued in the project, and zero for the rest of the years. After calculating everything, we get the total to get the cash flow. We use the cash flow to get the present value, which we will use it to get the MBV. Then will make the same as we said in the part 1. To get the IRR, we will use a different rate, and that the given rate was 20%. We can use a different, maybe 30%, any different rate, so we can do the graph and find out the rate at which the net present value equals to zero. That's it. And yeah, and we use the cash flow, which is not the present value, but the cash flow, to calculate the payback period, which is the year that it will take the project to get back to give us our initial investments. That's it. Thank you.